This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets. Oil prices rose on Thursday as crude stockpiles in the United States, the world's top oil consumer, fell to their lowest since January 2020, with Brent crude oil prices pushing back above $75 a barrel. Brent crude oil futures were up 45 cents, or 0.6%, at $75.19 a barrel by 13:42 GMT, having traded as high as $75.55. U.S. West Texas Intermediate, WTI, crude oil futures were up 56 cents, or 0.8%, to $72.95 a barrel. Brent topped $75 a barrel for the first time in more than 2 years in June, but fell back sharply this month on fears about the rapid spread of the Delta variant of coronavirus and a compromise deal by leading oil producers to increase supply.
Europe's top energy companies signaled confidence in a lasting recovery from the pandemic impact by drawing on higher oil prices to boost shareholder returns and reassure investors as they roll out risky climate strategies. After swiftly cutting spending and jobs in response to the unprecedented collapse in energy demand last year, executives from Royal Dutch Shell, Total Energies and Norway's Equinor were eager to highlight the rapid reversal in fortunes. "We wanted to be really clear and signal to the market the confidence that we have in our prospects and our cash flows," Chief Executive Ben van Beurden said on Thursday, after Shell launched a $2 billion buyback program and boosted its dividend for a second consecutive quarter, a year after cutting it for the first time since the 1940s.
Moving on to the top news in the energy sector.
Singapore residual fuel oil inventories fell 6% in the week ended July 28 as net imports plummeted to their lowest in more than 3 years, official data showed on Thursday. The net imports were weighed down by a surge in Singapore fuel oil exports, which hit a 9-month high of 592,000 tons in the week ended Wednesday, led by a jump in exports to China. Onshore fuel oil stocks fell by 1.53 million barrels, or about 241,000 tons, to a 3-week low of 22.9 million barrels, or 3.61 million tons, Enterprise Singapore data showed. Singapore's net fuel oil imports plummeted 91% from the previous week to 93,000 tons, the lowest since June 2018 and well below the 2021 weekly average of 709,000 tons. Weekly figures, however, are volatile.
China's coal-fired power generators have seen profits evaporate amid surging domestic prices, with imports unable to provide much relief amid an ongoing unofficial ban on buying cargoes from major exporter Australia. Out of 10 listed coal-fired power companies, 4 reported losses and 5 others saw first-half profits plunge, according to a report on Chinese energy industry website BJX News on July 27. The only utility to post a rise in profits was Changyuan Electric, which benefited from its large portfolio of renewable energy, according to Refinitiv analyst Yan Qin.
Next, we have the top news in metal markets.
Global demand for gold rose in the second quarter to its highest quarterly level in a year as central banks and investors stepped up purchases, the World Gold Council, WGC, said on Thursday. But with jewelry fabrication still reeling from the COVID-19 pandemic, gold use over the first 6 months of 2021 was lower than in any first half since 2008, the WGC said in its latest quarterly report. Demand from jewelers and central banks plunged when the novel coronavirus spread last year, unsettling state finances, shutting stores and hitting incomes.
China will raise export tariffs for pig iron and ferrochrome, and remove export tax rebates for 23 steel products from August 1, the second adjustment in 3 months as it seeks to ensure domestic supply while controlling output to curb emissions. Export tariffs for high-purity pig iron will be lifted to 20% from 15%, and for ferrochrome will be increased to 40% from 20%, the Ministry of Finance said in a statement on Thursday. The country will also cancel export tax rebates for 23 steel products, including some cold-rolled coils and silicon steel which have higher added value compared with carbon steel. We will now look at the top news in the agricultural sector. Indian traders for the first time have signed sugar export contracts 5 months ahead of shipments as a likely drop in Brazil's production prompted buyers to secure supplies from the South Asian country in advance, 5 trade sources told Reuters. Sugar production in Brazil, the world's biggest producer and exporter, is likely to drop due to a drought and frost that has damaged the sugarcane crop. Traders said the likely decline has already lifted sugar prices near their highest levels in 3 years, and it is prompting buyers to secure supplies in advance from India, the world's second biggest sugar producer.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.